You've paid a card off in full, watched your score barely move. You've closed an old card, thinking it was a smart cleanup move. Watched your score drop instead. You're not doing anything wrong. The rules just quietly changed, and almost nobody got the memo. The average credit score in America just slipped. Not because people got irresponsible, not because the economy collapsed. It slipped because new scoring models are rolling out right now in 2026, tracking things they never tracked before. And most of the advice you still believe about credit scores, the things your parents told you, the things that feel right, is actively working against you. Stay with me, because in the next few minutes, you're going to understand exactly what your score is measuring in 2026, the 5 myths quietly costing people thousands of dollars over a lifetime, and the handful of things that genuinely move the number. Let's go through these one at a time, because each one is doing real financial damage right now to people who think they're doing the responsible thing. Myth 1, checking your own credit score hurts it. This belief alone keeps an enormous number of people financially blind. They avoid looking at their report for years out of fear. But checking your own score is what's called a soft inquiry. It has zero effect on your number. The only thing that causes a small temporary dip is a hard inquiry, which happens when you actually apply for new credit. Looking at your own score as often as you want is not just safe. It's one of the few habits that costs nothing and only helps you, because it's the only way to catch errors or fraud before they quietly drag your score down for months. Myth 2, carrying a small balance instead of paying in full builds your score faster. This one is genuinely costing people money, not just points. The belief is that lenders want to see you using credit, so leaving a little balance and paying interest on it somehow proves you're a good borrower. It's backwards. Scoring models reward low utilization, how much of your available credit you're actually using, and paying interest on a balance does nothing positive for that number. It only costs you money. The healthiest pattern is using a card normally, then paying the full statement balance every single month. Myth 3, closing an old card you don't use anymore is a smart, tidy move. It feels responsible. Fewer cards, simpler finances. But 2 things happen the moment you close it. First, your total available credit shrinks, which means your utilization ratio, the percentage of credit you're using, instantly goes up, even if your spending hasn't changed at all. Second, if that card is one of your oldest accounts, you lose length of credit history, which is its own scoring factor. An old unused card sitting quietly open is often doing more for your score than you realize. The fix isn't closing it. It's simply not using it, or using it for one small recurring bill so it stays active. Myth 4, all debt is the same, so paying things off in any order is fine. Not all debt affects your score the same way. Installment loans, like a car loan or mortgage, and revolving credit, like credit cards, are weighted differently. Paying off an installment loan completely can sometimes cause a small, temporary dip because it changes your mix of credit types. That dip recovers. But high credit card utilization, sitting untouched, does ongoing damage every single month it's left high. If you're choosing where to focus financially, your revolving balances deserve attention first, specifically because of how heavily utilization is weighted. Myth 5, a higher income means a better credit score. This one surprises almost everyone. Your income isn't part of the scoring formula at all. The bureaus don't know what you make. A person earning $40,000 a year with consistent on-time payments and low utilization can have a stronger score than someone earning $400,000 who carries high balances. Your score reflects how you manage what you owe, not how much you earn. This matters because it means the path to a strong score isn't blocked by income. It's available to anyone willing to manage the habits that actually count. Now here's the part that's specific to right now, and it's the reason this conversation matters more this year than it did in the past. The first shift is something called trended data. Older scoring models took a single snapshot of your credit utilization, basically a photo of your balance on one particular day. The newer models being rolled out across mortgage lending this year look at 24 months of activity instead of one moment. That means a lender can now see whether your balance has been steadily climbing or steadily shrinking over 2 years, even if 2 people have the exact same balance on the day they apply. Someone who's been paying their balance down consistently now looks meaningfully stronger than someone who's just been treading water at the same number, even though older models would have scored them identically. The second shift is bigger, and almost nobody outside the finance world is talking about it yet. Buy now, pay later purchases are now being factored into credit scores. For years, those split payment purchases at checkout, the 4 installment plans for clothes, electronics, even groceries, were essentially invisible to lenders. People were quietly taking on what analysts started calling phantom debt, obligations that didn't show up anywhere a lender could see them. That's changing. New scoring models now incorporate this data, and studies on it found the effect moved scores up or down for the vast majority of people tested. On-time installment payments can help build your profile. Missed ones now hurt you in a way they simply didn't before. If you've been using these split payment apps casually, treating them as separate from real credit, that assumption no longer holds in 2026. The third shift is genuinely good news. Medical debt is being cleaned up. Paid medical collections and medical debts under $500 are being removed from credit reports altogether. For years, a single emergency room visit could sit on someone's report for years, even after it was resolved, dragging their score down for something that had nothing to do with how they actually manage money. That weight is lifting for a lot of people right now, often without them even realizing their score improved because of a policy change, not something they did. Put together, these 3 shifts mean the same habits that used to be good enough might not tell the whole story anymore. Lenders are watching trends over time instead of single moments, watching a category of spending that used to be invisible, and in some cases, forgiving old medical debt that was never really a reflection of financial responsibility in the first place. So with the myths cleared up and the 2026 changes understood, what actually works? Payment history carries the most weight of any single factor, roughly a third of your score. One missed payment, 30 days or more past due, can leave a mark that takes months to fully recover from, and it can stay visible on your report for years. The single highest leverage habit anyone can build is simple, almost boring. Automate every minimum payment, so a late payment becomes structurally impossible, even on a month where life gets chaotic. Utilization is the fastest lever for actual movement. This is the one number you have the most short-term control over. The general guidance is staying under 30% of your available credit, but the real sweet spot for a strong score is closer to 10% or lower. If your goal is to see your number move within the next billing cycle, paying down balances before your statement closing date, not just before the due date, is the move almost nobody explains clearly. The balance reported to the bureaus is usually a snapshot from your statement date, not whatever you happen to pay later. Length of credit history rewards patience, not action. This is the one factor where the best move is often doing nothing. Keeping old accounts open, even unused ones, because the average age of all your accounts together is part of the formula. This is exactly why myth 3 from earlier does real damage. Closing an old card doesn't just raise utilization, it can quietly shorten your average history too. And the newer factors, trended data, and now BNPL activity, reward consistency over time, not a single good month. A score isn't built in a week. It's built by the same handful of behaviors repeated, month after month, until the trend itself becomes the strongest evidence a lender has that you're a reliable borrower. None of this requires obsessing over your score daily. It requires understanding what it's actually measuring, so the effort you're already putting in stops working against you by accident. Here's the real takeaway. Your credit score was never a measure of how much money you make or how careful a person you are in general. It's a narrow, specific measurement of how you've managed borrowed money over time,